What's going on, everyone? I'm here today to look at another dividend stock. And I'm doing this so I can build my bridge account. And I am looking for companies to buy. Now, I haven't decided how many I'm going to buy to add to my dividend portfolio, but I want a good amount. Maybe 30, maybe 20, maybe 100. I haven't decided, but if you don't know what a dividend stock is, here's a video about a dividend stock and what it is.
Understanding dividend in 1 minute. Imagine owning a potato farm. You start with 50 potatoes and seek help from your friends for 50 potatoes more. After harvesting 200 potatoes, you keep 100 potatoes for replanting and you distribute the remaining potatoes amongst your friends. Similarly, company distribute a portion of their earnings to shareholders as dividend. These are the portions of business earning or profit that are distributed to the owners or shareholders as a reward based on their ownership share or contribution to the business.
Stock is, I wanted this bridge account because I wanted passive income. Why do I want passive income? Well, because I don't want to work forever, and this will help me.
Dividend investing is kind of fun in the fact that it is a positive action, meaning a company is giving you money. You can either reinvest it or you can just keep it in cash. You typically, somebody who's closer to retirement will probably keep it in cash and use that as kind of an income source. But a younger person, a lot of times you see them reinvesting and they get so excited. This company paid you money. You bought more shares. So you've got the positive action of buying more and growing. You've also got the action that you receive something and there's this implied contract that's got to be a good thing.
With bridging my retirement. Even though I can retire right now, I want to go from coast fire to fat fire. And if you don't know what fat fire, coast fire is, here's a video about financial independent retire early.
For short, was just a spark. This hardcore savings strategy had one goal: to retire decades early. Now, fast forward to the present, and fire has grown into a roaring flame, offering a buffet of lifestyles for every taste. The newest addition to the gang, Coast Fire, emphasizes front-loading savings early, allowing time and compound interest to shoulder the bulk of retirement expenses. Yet, the allure of Coast Fire? It's less intense. Say goodbye to the pressure of retiring prematurely or getting wound up over budgets.
Financial independent retire early is, I am building a passive income. So if you don't know what a passive income is, here's a video about passive income so that you get a better understanding.
Yes, I'm serious.
Okay. The quickest way to not be on a beach in Mexico is to think that passive income exists. I think the reason so many scumbuckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate.
Now, how will I choose my stocks? And this is the thing you need to understand. After I read The Intelligent Investor and listened to Warren Buffett and spent a few years, 10 years, 15 years, to studying about real estate and stocks and investment, I decided this is how I want to invest. And it's because of what Warren Buffett said. And this is what he said.
Was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business, and I did not care whether a stock went up or down the next day or the next week.
Alrighty, now we know what Warren Buffett said, and we know how this is gonna go. What are my requirements for my dividend portfolio, which is gonna be my bridge account? Now, if you don't know what a bridge account, here's the definition on the screen so you understand that it's just an account that helps bridge my retirement to my now. So I have extra money. Now I can coast fire right now. I don't have to work. I'm financially independent, retire early. But I decided to continue working so I can build my bridge account and build my retirement account to fat fire. Now, here are my requirements for my stocks. My first requirement is, since I want this as a passive income, I wanted a dividend paying stock. So it has to be a dividend paying stock. Make sense? Number two, it has to be a good performing stock. That means it can't be only returning 2%, 4% a year. I'm looking on average about 10 to 14%. It has to outpace the S&P. Now, will it always outpace? Maybe, maybe not, but I want to try. And that's the thing. I want a good growth stock. Number three, I want to make sure they're financially stable based off my determination. Because I used to own a company, I like to look at different things that the average investor don't look at. Now, everyone likes to do prediction. I just like to look at the numbers in front of me and determine if it's a good company to buy, because I'm planning on holding this for the long term. Now, everyone has their own different ways. And lastly, do I want to even own this company? Because some companies might have good numbers, good dividend, but I just don't want to own them because I know nothing about them. So this is what I require. So let's get into this. And what stock am I looking at today? It's an insurance company called Chubb. I thought the name was kind of cool. So what is Chubb? Well, they're an insurance company for individual, family, business, and this is something that everyone is going to need. It's a commodity, and this saves you. So I wanted to add an insurance company to my portfolio just so I can help diversify. Diversification is pretty important for your portfolio, and this is one thing I'm trying to diversify. I understand insurance, and I understand what's a good insurance and a bad insurance. So I saw this, and I thought it was a great company to look into. Now, it has 200 billion global asset backing it. It paid 21 billion out globally, and it's over 54 countries. So it's a worldwide company, and that really led me to look into this company. Now, I could keep going on and on about it, but I like to go to the Wikipedia because it sums it up. It might not be 100% correct, but it helps me thin it out a little bit that I can have a better understanding. So, Chubb Limited in America and Swiss. Company is incorporated. Okay. I'm going to just quickly read this. So, here's the thing I really like to look at is to see these revenues going up, operation income's going up, net income is going up, total assets going up, and total equity is going up. That all looks good to me. That means this is a growing company. If you're not a growing company, you're a dying company. And that's what we say in business. So, looking at the Wikipedia, it looks like the history of it does well, and it does a pretty good job on managing its company. So let's get into this company, and let's get into MSN. I like using MSN just because it has a lot of free stuff and makes my life a little bit easier. All right, I like using MSN because it lets me go and figure out what each one of these information is, and it makes my life easier because it's free. So 1 year is negative 9.63%. 3 years, it is up 36.09%. 5 years is 108%, and maximum is up 2,000%. And they do pay a dividend of 1.45%. So looking at it, it looks like it's just hit a slump. I'm not sure why. I have to look at the finance because the finance will tell me if it should be going up or not going up. Because if they're making more money and they're more valuable, it shouldn't be going down in value, but you never know. But all right, let's go into this. So they have a 1.44% dividend yield and a 3.88 annual dividend. And they have a 6.21% dividend growth. So growth years is up is for 33 years. So it has been paying dividend and growing it for 33 years. So it is a very good dividend paying stock with a long history. So I'm pretty confident I can trust this. But all right, I now know the performance, it pays dividend, and now let's look at the finance, see if it has a reason why it's going down. Well, from 2017 to 2024, it's gone up every single year. By last year, from 2023, went up 15% of revenue growth. 2024 is 12% revenue growth. Those are really good growth for this size of a company. But let's see what is their net profit. I like to see around 10 to 15% bare minimum on net profit. And they're doing a 17.29%. And that's a pretty good one. Now, when I say 10 to 15% net profit, this is profit after everything is paid. And that's one thing I like to see because they're making money and it gives it wiggle room for growth. And it ensures that they keep paying dividends because they can afford it. Now, let's see what the balance sheet says. Balance sheet is pretty important because it tells me if they're doing good or bad, or if they're increasing their debt or lowering their debts. So they're worth $26 billion. And this is what they are worth by goodwill, brand recognition, and intellectual property. So that is what they're worth. And their long-term debt is $14.8 billion. It went up by $1.5 billion, which, okay. And they kind of stay between 15 to 14. So it's not going down, it's going up. I don't like seeing that, but they could have done a growth or something. It's acceptable because it's not that much of debt for long term for this size of company. Now, I don't like seeing it going up, but at the end of the day, it is what it is. Now, shareholder equity, it says 64 billion, 59 billion. That's not bad. And now the big part is cash flow. Operation cash flow is 16 billion. Investment cash flow is 13 billion. That might be why they used a lot of investor cash flow. Financial cash flow, negative 2 billion. Ending cash position is 2.55 billion. And 2023 is 2.6 billion. So their cash flow is actually going up year over year. I like that the ending cash flow is higher. And the other thing I really like about it is the free cash flow. It has an increase in free cash flow almost every single year. It has $16.18 billion of free cash flow, and it went up $4 billion from the year before. So that's a really good position, and I want to go back and see this. So it went up $4 billion of free cash flow. So they really did need to take off another $1 billion for long term. They would increase the cash flow by $1 billion. So for me, it kind of counteracts it and shows that they're making pretty good money. Another thing I do like to see is what the company is doing, who's buying, who's selling. And this is just for me to have a better understanding. They do have some people selling and buying. This Lupik John J, he sold $1.6 million worth, 344K. That kind of makes it harder to increase the value whenever you have people inside the company selling. All right. So financially, I think they're pretty solid. They have a good profit margin, and this is for insurance company. Now, the analysts do give this a buy. And lastly, I want to see what AI says about this company. AI's gathers up all the data and compares it and see if it's good. Valuation 4 out of 6. So it compares it to all the other ones in the industry, and industry standard is 11.87, and it's or 14.4, and it's at 11.87. So it's not with the industry standard, it's a little bit below, but that's fine. I believe this Marsh and company is skewing the data by a lot. They're way up here. I have to see what that company is later. And then let's look at the earnings. Well, let's see. Analysts do say buy. Look at the earnings. They're making pretty good money. Well, the peer average is way up here. But if we exclude Traveling Company Inc., American International Group Inc., I'm not sure if they're actual insurance companies. And this is Marsh and McLennan Company Incorporated. This might not even be an insurance company. So I have to see. But the earning per price share is going up, and it's pretty good. Now, the future growth. American International Group Incorporated is way up here. So I don't actually think it's that bad. I think, and then historical net profit growth is what I want to look at. It's pretty good for her. And then financial health, debt to equality. Yeah, it took out some money, and I see why it's going down, but it has a lot of wealth built up. And let's see its return compared to everyone else, and it has a pretty good return. This Marsh McLennan Company is really skewing the data. Will I buy this stock? I think I will. I think I'm going to buy a couple $100 to fill them out and then sit on it and see how well they do. I'm not going to throw $1,000 at this yet, but I'm going to throw some money. I think it's going to recover because it pretty much passes all my qualification. The performance part is kind of low, but the 3-year and the 5-year looks really good for it. And that's what I'm looking at for long term. And finance looks well. It pays a dividend. And I wouldn't mind owning a part of an insurance company. So are you going to invest in this? It's up to you. Do your due diligence and like and subscribe to my video.